Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Wednesday, May 26th, 2021. And here are our top stories. Democratizing direct real estate in defined contribution retirement plans and the evolving liquidity landscape. Well, joining me now to discuss this and a lot more is David Levine. He's a principal with Groom Law Group, and Drew Carrington, Senior Vice President and Head of Institutional Defined Contribution for Franklin Templeton Investments. Gentlemen, great to see you. Thanks so much for joining us on the program this morning.
Good morning.
Good morning. It's good to be here.
Good to see you both. David, I want to start with you, and I want to talk about the information letter that I guess we're going on about a year now, that this information letter was released on illiquid investments in defined contribution plans. I think that letter was focused on one asset class, but this has broader implications. What can you tell us?
Sure. And Jeff, I think it's good to step back for a moment. One of the things to think about is we've moved from a world that's primarily a defined benefit style system to a defined contribution in the United States. Not to say there aren't still active defined benefit plans, but it's a declining portion of the market and support for retirement. And as part of that, you've seen a move that originally started out with maybe insurance, then mutual funds, then collective investment trusts in the 401k space. But on the defined benefit pension side, there's historically been a wide range of assets used. Everything from publicly traded equities to private markets to even now infrastructure, private real estate, all these different items that are out there, even venture type of items. You put all those things together, what that has meant for us at this moment is that defined benefit plans arguably have had a broader palette of investment options to choose from than the 401k market. Now, there's different views on this back and forth, but this information letter, the key takeaway, it's the DOL said, look, it can make good sense to have alternative investments in a defined contribution solution. Importantly there, it was framed not as a standalone investment. It was basically sort of an asset allocation, almost, let's just put it into English, almost like a target date type of world is what people take it as, where you have a sleeve into alternative asset classes such as private real estate or other types of items. And those types of items, as you take it, provide potential diversifiers as well as risk, as well as also enhancements to returns. Each case you have to look at on their own, but the DOL basically recognized there could be value here. And now the industry is saying, since we're focused on decumulation, how do we move this ball forward? Because we need more money than ever in retirement. And how do we keep the money running, not until people's 70s, but until their 90s and later?
Drew, I want to come to you. You have your ear to the ground when it comes to consultants, the employers that sponsor defined contribution plans like 401k, 403b, governmental 457 plan. Acknowledging that direct real estate is an important asset class, it's a diversifier, since the information letter has come out, have you seen much greater interest among these groups of important constituencies?
Absolutely. What the information letter really did for a lot of influencers, deciders in the defined contribution space is it said it's okay to use these asset categories. So there's nothing inherent in ERISA that says you can't do it. So can we figure out how to administer these asset classes, and then what's the right way to incorporate them in participant portfolios? That's really kind of what the DOL information letter was getting at is, in a professionally managed asset allocation structure, these asset classes make sense. What we're hearing from plan sponsors and the producers of these products have been in the market talking to plan sponsors and consultants for quite some time. So there are some DC plans that already use private real estate in their target date funds or custom target date vehicles or real asset structures. Real estate is the one that in many ways felt the easiest to do initially. It's a familiar asset class. But we're starting to see those conversations broaden out across additional categories, as you alluded to, private equity or hedge funds, infrastructure. But we're definitely hearing that. And what people want to know is, can I communicate it? Can I allocate it into portfolios? Can I administer it? Can my record keeper administer it? Can I disclose properly the allocations and the costs that entails? There's really not a lot of argument about it. It's beneficial for portfolios. It adds value either in the form of increased return or reduced risk or some combination thereof. And the proof of that is that most institutional investors, not just DB plans, but endowments, foundations, even DC systems in other countries, more broadly utilize alternative or illiquid asset categories. And this trend, we refer to it as democratization, it's broader than just the DOL letter. The outgoing chair of the SEC, Jay Clayton, talked about this democratization trend. We've seen changes to the accredited investor rules to try to make it available to the typical participant. And in many ways, it's a fairness question. Shouldn't the typical 401k plan participant have access to the same kinds of asset classes, the same broad toolkit that institutional investors and wealthy individuals have access to?
Yeah, and just to follow up on that, I know that when you look at other systems around the world, and you and I were talking about this with David offline, there are other systems that are using direct real estate, using alternative asset classes within their defined contribution system.
Yeah, the Australian superannuation system is maybe the best example of this. It's a defined contribution system. It's got almost $2 trillion in it today, 20-some million accounts in that system. And they have been using what we would consider in the US and the USDC system alternative asset classes for many years. And in fact, the system overall has an allocation to private real estate of about 10%. So a really significant commitment to asset categories, again, that we think of as alternative, have been sort of the norm in that portfolio for a number of years. And the benefits to individual participants are readily visible. You get scale pricing, professional oversight, institutional buying, fiduciary oversight in the portfolio. So you're not asking individual participants to make decisions about, do you want to own warehouses or retail or office real estate? You've got a professional manager and then a professional allocator on top of that, making those decisions, and varying the weights to real estate as people get closer to retirement. To David's point about, the decumulation phase, real estate in many ways is an attractive category for participants who are looking to de-risk out of equities.
David, I want to come to you. I'd be remiss if I didn't ask you about some recent litigation, or at least, recent decisions. I think there was one recently around Intel, January of this year, of 2021, that may have broader implications and kind of ties in, I think, to our conversation. You want to take a stab at that?
Sure, absolutely, Jeff. And I want to mention one thing Drew said as well. Drew made an excellent point about the use around the world. It's not even just around the world, it's even domestically. In the domestic side, we have, for non-ERISA plans, for governmental plans, governmentals going down this road. This is not necessarily a Democrat or Republican or sort of type of divide in this discussion, but there are governmental plans that actually use these types of investments, and they think about all the different pros and cons. So it's important to keep that in mind. But let me pivot to Intel for just a couple seconds. So we basically have the Intel case that's gone up to the Supreme Court, back down from the Supreme Court, still moving forward at this point. There was a decision where the court basically said, you can't use the apples to oranges comparisons that they said that the plaintiff's lawyers made, and as a defense lawyer, I would say the same thing. And importantly, they also sort of affirmed the concept, in my mind, that there is no sort of default that you must be inside this narrow box. One of the core concepts we're really talking about here is innovation. whether it's private real estate, other asset classes, or other items. We are looking at a world right now where we're trying to make sure people can get through retirement. And we need innovation to get there. And the Intel decision affirms that it's not just everything is a cookie cutter identical at this point. Now, this case is, I know it's going to sound weird, early, even though it's been going on a long time. But the court's decision there really highlights that you can't just assume it should always be cheapest, simplest in terms of items. You need to have a good fiduciary process. As Drew pointed out, you've got the governance and like the supers in Australia. But a real big takeaway on this is that there's value from different types of asset classes and different type of innovation as we go forward. And Intel says it's not just about a race to the bottom. And you know what? If that gets to better outcomes, that's a great solution.
Thanks, gentlemen. Great to see you. Thanks for sharing your perspective. And when we come back, we'll talk about the evolving liquidity landscape. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. I'm now joined by Robert Palmeri of UBS Realty Investors and Glenn Coyle of Benefit Trust Company. Gentlemen, great to see you. Thanks for joining us this morning.
Thanks for having us.
Jeff.
Yeah, it's great to see you. Rob, I want to come to you because you and a group of professionals within the Defined Contribution Real Estate Council recently authored a white paper around the evolving liquidity landscape, hence the name of our segment. What can you tell us? What's the thesis there? And what have you seen in terms of illiquidity and liquidity evolving with these investment products?
Yeah, great, Jeff. I'm a part of the, I co-chair of the DCREC's Best Practices Committee, which is where the paper came from. And so to your question, so liquidity is no longer a barrier to implementing private real estate in a DC plan. And when you think about liquidity, I've been managing DC plans for the last 20 years. Liquidity, managing liquidity in DC plan is not something that's new to plans. You had to manage around stable value. You had to manage around, I even remember passive index, had some of their redemption challenges back after the financial crisis. So it's nothing new. The paper that we drafted really talks about a couple of points that make the industry evolve into the ability to use private real estate. And so there are a couple of things that have happened in the last 5 to 10 years. First is participant inertia. And participants do not move money. Now, that's not something that happened in the last few years. That's just, I think that's, at this point, it's almost common knowledge. There's a lot of documentation on how participants don't move money from one fund to another. They're not very active. And what that means is that, plan sponsors and consultants, have the ability of a very stable asset base that they can carve out some of their assets for a less liquid asset class like private real estate. Another trend that is, a trend that is happening within the DC market also is the use and popularity of white label funds and custom target date funds. And, those are two investment structures, if you will, in a DC plan that allow a plan sponsor and consultants actually carve out and use private real estate. Because in, for example, a target date fund, you can have a very stable exposure to private real estate, and all the flows, the participant flows, can come in and out of the remaining part of the custom target date portfolio. So those are trends that are happening within the DC market. And then finally, what I'll say is that auto features, auto enrollment and auto escalation are features that have become very popular among plan sponsors. And what that means is that the plan, if you implement the auto features, you'll have a good amount of flow coming into the plan, right? And what that does is, if there is any plan redemption or redemptions from an investment option or any exchanges between investment options, having this consistent flow of money keeps the asset base stable. Again, allowing plan sponsors and consultants to be able to use private real estate in their products, in their menu. Last thing I'll say, and we allude this to we talk about this in the paper, is the NCREC Daily Price Index, which is the National Council of Real Estate Investment Fiduciaries. They create indices for the real estate industry. They created an index for daily price products. And today there are 11 products that make up that index. And I'll leave you with this. There are a lot of managers that are exploring and in the design stage that we'll see more products coming out. And I'll just say that, lastly, I'll say that managers are getting much more creative every day, quite frankly, with new products.
Yeah, and thanks for that, Rob. And Glenn, I want to come to you because your firm really specializes in holding assets or trusting assets and exchanging data with third parties like record keepers in order to transact and do the transfers that Rob was really talking about at a different level. Have you noticed within your clientele and even inquiries a movement towards illiquid investments like direct real estate in client portfolios?
Yeah, thank you, Jeffrey. A bit of a trust. We've been successful in launching. We've got a handful of private asset type funds, and we call them, we refer to them as private investments versus illiquid, just because we are able to strike a daily NAV, as well as provide liquidity, if it's properly structured. As far as adoption in the target date fund space, we really haven't seen that uptake yet. Primarily, we've seen it in the pension structures and so forth. But we have seen an uptick and an increase in inquiries, as Rob mentioned, as well as the increase of, third-party managers calling us and talking about developing funds specifically for this space. So we've definitely seen an uptick there. And I think with the information letter that was delivered last year, you couple that with the public market expected returns going forward, we really do believe that private investments, we're going to continue to see an increase in adoption.
Yeah, and my apologies for calling them illiquid investments. You're right, they are private markets, some of which are illiquid. Just to follow up on that, Glenn, when you're implementing these new funds, what are some of the things that people out there watching, whether they're an employer, whether they're a consultant, whether they're even a participant or employee in a plan, what are some of the things that need to be considered when setting up these types of investments within a platform like Benefit Trust Company and also a record keeper?
So, when we establish funds, we really think about it from a couple of different segments, which encompasses the fund establishment. And the one is just having a general understanding. So when we talk to our prospective managers, advisors, the various stakeholders, and about launching a fund, we want to understand the goal of the fund and the audience for which it's intended. This allows us to help tailor the structure, and it minimizes really any surprises during the fund setup process. This also encompasses a roles and responsibility discussion. In reality, a lot of people don't realize that the trustee has official oversight over the fund. And then secondly, the documents are key. We have to have everything in sync from the private investment fund to the CIT. For example, we don't want the CIT to be able to have more generous terms, I should say, than the private investment itself. And then I'd say lastly is operational. All the stakeholders involved in establishing the fund. It's important that everyone understands how the private fund works, how the CIT is going to operate. For example, when will the NAS be delivered? When do subscription documents need to be submitted, and so forth. So at the end of the day, it's important that everyone knows the roles and responsibilities, that the documents are in sync, and operationally that everything fits together and is operationally in sync.
Yeah, you got to dot those I's, cross the T's. Rob, I want to come back to you. In our last segment, we talked about democratization of investments and having access in a defined contribution plan similar to the access that you might have in a pension plan. Are you seeing more employers, clients of yours, or people that you're talking to with consultants having a much greater interest given what we've discussed previous around liquidity, but just knowing that it makes sense as a diversifier to include direct real estate in a retirement plan?
Yeah, so yes, I would say, again, the quick answer is yes. We're starting to have a lot of conversations with investors and consultants on this topic. And, I think it has a lot to do with the fact that many plan sponsors and certainly consultants have experience in using, private real estate in their DB plan. And so they really understand the benefits that it brings to a portfolio of cash, stocks, and bonds, which really is what historically DC plans were only invested in. And when you add private real estate, it really improves the outcomes, the investment outcomes of the portfolio. And so plan sponsors are looking at that saying, how do we get this into our plan, our DC plan? Particularly in light of the fact that a lot of DB plans are starting to de-risk or freeze. I will say this in terms of the willingness to talk today versus 5 years ago. Proof of concept, ourselves included, we've been doing this since 2012, and I will tell you there's some record keepers that have products that out there have been doing it for literally decades. So it can be done, and it can be done successfully. And then, Glenn mentioned the DOL letter. I think that was extremely well received in the market. And I think it was kind of it was extremely helpful to hear from them, and kind of happy that they did respond. And then lastly, I would say, I forget if it was late last year or early this year, there was a favorable outcome in in a litigation case, high profile litigation case that used not only private real estate, but also private equity as well. And I think when for a ERISA plan, when you see something like that, I think that's extremely positive. And so, yeah, we've been having conversations, and my intelligence in working in some of these industries and collaborating with other investment managers is that we are having a lot more discussions, and we're happy to see that.
And that wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, then drop us a line. And don't forget, for all the information in retirement, markets, technology, personal finance, so much more, all in one place, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow for another entertaining, educational, and exciting episode of BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited, and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.